An interest in a discretionary trust doesn't have an estate tax value, but it may have a gift tax value, and you can't just assign it a zero value. The IRS has ruled such, but of course has offered no helpful opinion or guidance on a factual determination such as how do you value a discretionary interest in a trust. So there's no good answer, but today is all about piecing together some of the old guidance we do have access to give us tea leaves to follow. There's an old revenue ruling, 75-550, which may help but has been superseded by actuarial tables since published by Treasury. But from that we can at least glean some of the common factors that could come into play when valuing a discretionary interest in a trust. I'm Griffin Bridgers, and this is 10 Minutes with Griffin. For today's episode 194, we're going to get into a subject for which there's no good answer. So a lot of you are probably asking, why ask this or why even present on it? Well, what I want to give you is kind of what I've been able to quickly piece together through research that may help, but at the end of the day, I can't really guide you to a specific IRS ruling or publication that says this is how you do it, mainly because discretionary trusts may vary so much in terms of their terms and even the way that they are administered. Now, as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. And if you'd like a copy of these slides, please email me at griffin.bridgers@gmail.com. Now on to the presentation. So, a lot of times we don't care about the value of interests in discretionary trusts, mainly because they typically don't have an estate tax value. If you die holding an interest in a trust where the trustee could have given you interest or principal based on some sort of discretionary standard, then your interest in that trust ceases at your death and thus has a zero estate tax value unless the trust is a Q-tip trust or there's a power of appointment that creates a state inclusion, or you were the original grantor of the trust and you've retained that beneficial interest. In any of those cases, you don't really have to get into any sort of actuarial value. The IRS just looks to what's the value of the trust at date of death. However, from a gift tax perspective, a trust may have value based on the benefit you could receive over the rest of your lifetime as a beneficiary, instead of whether or not anything would be included in your gross estate. Now, the value is often based on the certainty, amount, and frequency of trust distributions, and that's going to require some forward-looking analysis, some backward-looking analysis to the history of the trust, and there's really only a concern here where you have an interest in a trust that's released during a beneficiary's life, maybe through the exercise of a lifetime power of appointment or a decanting of the trust or any sort of modification that the beneficiary may consent to. Now, with that being said, there is IRS guidance already that says if there's a mandatory income right, that's a life estate, and it is capable of valuation using IRS tables. Similarly, if you have any sort of other mandatory distribution right that's set in amount and frequency, like an annuity or unit trust distribution, those are capable of valuation as well, and there's specific guidance on those. But with a discretionary interest, the trustee can pick and choose who receives distributions, maybe among a pool of beneficiaries, and those distributions can vary. So those types of interests are difficult to value to begin with, which may be why the IRS is so reluctant to really give guidance here. You can find in the Chapter 14 rules that from a gift tax perspective, if you retain an interest that's not an annuity or unit trust or life estate type of interest, the IRS gives it a zero value anyway. So you could always make the argument that you could go the other way and claim that there is a zero value to that type of interest anyway, but for the time being, we have one data point that says you cannot do that you cannot assign a zero value, and that's found in Private Letter Ruling 2011-22007, where the IRS ruled that there is a value that you can assign to a discretionary trust for gift tax purposes. And of course, since that is a factual determination, the IRS refused to opine on the value or even the methodology getting there. Now, the IRS acknowledged in this ruling that the value may be nominal, And I've seen a number of articles on this ruling saying, yeah, you can just give a nominal value to a discretionary trust interest. But it's important to note that the ruling itself tempered that determination. And really, it said it was nominal not based on the fact that it was a discretionary trust interest, but more based on the fact that as part of this ruling process, the beneficiary and trustee submitted information and even an affidavit saying that one, the beneficiary had no need for trust distributions whatsoever, and two, the beneficiary in question had never received a trust distribution. So even though the historical administration of the trust and the way the trust was going to be administered in the future gave no benefit to that beneficiary, the IRS still said you can't assign a zero value to this discretionary trust interest. Now, there is a old revenue ruling, 75-550, which was applied in a different time, in a different context, and was used to determine a value under a prior transfer credit prior to our more modern gift tax rules, which kicked in 1977. But this ruling nonetheless seemed to condone a method for calculating values for a discretionary trust distribution. Now, it's of limited utility probably given that it predates the Treasury's publication of its own actuarial tables under Treasury Regulation 20-2031-7 or 20.2031-7, but there's still possibly a general procedure we could use here where you could take the beneficiary's age, you could figure out an annual income rate, and the ruling used 3.5% as a flat amount through the calculation period. You'd also look to the mortality risk of that beneficiary in each year, which you can find in IRS Table 2000 CM. And then this was very favorable to the beneficiary, but you'd look to the history of the trust and the needs of the other beneficiaries and determine the maximum estimated principal which could be used for other beneficiaries. So for each year, you'd one, assume that there'd be other principal distributions, take those out, and whatever was left in principal, we'd assume that's the base principal remaining to determine the income distribution to the beneficiary. So in this case, there was $100,000 in principal going out each year, so they just took the fair market value of the trust each year minus $100,000, then multiplied that times 3.5% to determine the income amount. Then that income amount was adjusted for mortality risk each year by comparing that valuation year to the age in each subsequent year. So there was an ever increasing mortality risk that reduced that income amount, but within that it ended up being a straight line addition, and I don't have the numbers in front of me, but basically the IRS just determined how much income would the beneficiary get each year until the principal is drained to zero, assuming that there's no growth in principal, and there was no time value discounting for that income back to the present either. So they didn't even dig into the 75/20 rate or anything like that. So it was really just kind of a straight line calculation of the income that they could assume that the beneficiary might reasonably receive each year without looking to any principal that could go to the beneficiary, instead assuming that principal would go to the other beneficiaries who had greater need. So it was an odd calculation, and I think at the very least you'd have to add in maybe looking at would the beneficiary get any principal and would there be any time value discounting of that income stream that would otherwise be received. But either way, key takeaways here is that one, we know that we cannot assign a zero value based on this private letter ruling. And while the facts are unique to that, what we do have is representations that the beneficiary in question there had no need for trust distributions and would have no need for trust distributions, and a trustee's representation that they wouldn't distribute to that beneficiary. But nonetheless, the IRS still said, even though the value is nominal, it's not zero. Now, we have Revenue Ruling 75-552, which relied on tables which have been revised and superseded, and has some guidance that we may be able to use and some nuggets we can take away, looking at things like distribution history, beneficiaries' needs, and an income rate. But the income rate is largely reflected in life estates anyway. So as I mentioned back here, this was almost like a life estate type of analysis, but with an assumption of max principal going to the other beneficiaries, which would reduce the value of that life estate every single year without time value discounting within that reduced principal as well. Now, it's important to note again, this only becomes an issue if one, the trust is not includable in the gross estate of the beneficiary in question, and two, if that beneficiary releases their interest in the trust in a way that generates a gift. In that situation, there could be a gift tax here, but if there's just bare estate inclusion, like with a Q-tip trust or something where there's a general power of appointment, there is no value. The IRS says if you're gifting away the property in trust and it's going to be included in your gross estate ultimately anyway, they're going to treat that as a fair market value gift of whatever's in the trust at the time. As always, if you have questions or topic suggestions that are not client-specific questions, you can email those to me at griffin.bridgers@gmail.com, but as a reminder, I cannot give tax or legal advice by email. Thank you for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.